Yeah,
Look at this thing.
yeah. Too up, too down.
Look at this
Hey,
thing.
yeah.
Money.
Yeah, I wanted the crown and to be celebrated. I rented a tux and I ordered a mink. Stood in the mirror like mama, I made it. Proceeded to brushing the teeth in the sink. Caught me a grill and I'm so melanated. I polished the chain, I ain't gold in the link. And I got me a baby who gave me some babies. I'm raising a lady and building a king. Too cold, you too busy running with another man lane, I guess. Yeah, too bold. I be running on the one way, never change my set. Like, I don't ever use my signals. Yeah, I be in the lane myself. Yeah, I don't gotta change my mental. Yeah, and I ain't gotta chase my wealth. And I accept my daddy got a kingdom, and everything I ever got is his. If I ever got a problem, I'ma seek him. I never doubt him. Been about his biz, oh man. Been at. I ain't gotta ride on the wave when the ocean is his. Close with the kid with a
What's good, baby? It's your boy Dale. I'm back in the saddle again. Our motto is to buy, build. We already bought it already, so we already own it, free and clear. Refinance to long-term debt, cash flow. That is the motto. Cliff, man, is that a pretty strong motto, man? What do you think?
Man, the model is strong. Like, you're getting each piece of the invest, right?
My bad, y'all got to turn it on. What's up, y'all? It's your partner Dale, looking oh so fresh, cold, clean, and welcome again to another edition of Real Estate Friday Live, guys. And you have your partner here, Cliff, is taking care of some family business. He'll tell you guys a little about that later on, guys. But I want to say welcome again, guys. I hope you guys had a phenomenal week. I know that we did, and yes, we got the bag. Yes, we did, guys. So, man, welcome again, guys. We're gonna dive right into this thing. We ain't gonna waste no time at all. If you could, guys, do me a favor, share, no matter what platform that you're on, and then like and subscribe to the channel so we can actually get that algorithm up, guys, so we can continue to get out good, valuable content. So, guys, welcome again. We're gonna dive into a topic, guys, that's really tight, man. You know, first and foremost, we do every single day as we go through the current market analysis. And I thought it would be wise, guys, for us to bring this in, for us to really look in and see what's really going on with the market. Now, we understand that there's been a lot of, there've been some rate cuts, and there's also been some type of communication from the Fed to talk about they're going to, of course, cut some additional, I think one or two times to see what's going on. And so after the rate cut, I thought it'd be wise for us to kind of look and see what's really going on and see realistically if this is really helping out the industry, because the market, because a lot of individuals, what they're saying is, well, the rate cut's going to be great for everybody, which is good and fine and great. But hey, guys, I thought it'd be wise for us to kind of look in and see what's really going on. Did the rate cut really, has it helped the market? That's going to be our current market analysis. It's going to be us walking through this rate cut, because there was a big old thing and it was on all the news outlets, things of that nature. And that's fine. That's cool. That's gravy. But let's see if this really helped the market from an honest perspective. All right. Let's really see if it really helped the market. Let's dive into this real fast. Let's bring in our guys from RE Consulting. I like this gentleman because what he does is he gives a good balanced view of what's really going on, guys. He's not selling too much to us at all. And what I like is I like for people to kind of give a good balance of what's really going on, so we can kind of really get around all of the spin and really look at the detailed facts. And so, hey, let's see what he's actually talking about, guys, real quickly here. Again, we're going to talking about this here. Has the rate cut helped? So the first topic we're going to talk about is this here. Realtor.com is now saying that 40%, there's an inventory spike of 40%, right? And we're going to walk through what this looks like and see if a spike is good. Now, this is post the rate cut, after the rate cut, and also after the Fed talking about there'll be additional rate cuts as well. So let's see what's going on. Let's dive into that. Here we go.
Brand new inventory data from Realtor.com shows a massive increase in the supply of homes on the U.S. housing market for sale. This big increase in supply was relatively unexpected and is now causing home price growth to slow and even decline
Whoa,
in many cities and states across America.
So right off the bat, he's talking about home prices slowing and declining, which is correct. I'm in Texas, and we're beginning to see a lot of homes in the area that I'm in. I'm the Dallas-Fort Worth Metroplex, and typically Dallas is a hot market right now. There's a lot of price cutting going on in Dallas, whether it be Dallas County, Collin County, Tarrant County. You have Rockwall County, Fannin County. Those are typically hot areas, right? Because Dallas is kind of a thriving city when it comes to real estate. But you are beginning to see rate cuts even in the Dallas-Fort Worth Metroplex. Now let's not talk about Austin or Houston, which H-Town, San Antonio. There's a lot of things going on, but I want you to hear I want you to watch it, see what he's going to say. Here we go. Let's dive into this.
You can see, folks, this data.com now shows that we're up to 941,000 homes on the market.
That's crazy.
In America, up 34% year over year. And this inventory, it's now the highest since January 2020, everyone. So the highest inventory in almost 5 years, and we're now almost back to pre-pandemic levels. And in particular, this inventory growth is biggest in the South America. We're seeing massive pile-ups of listings and homes for sale in states like Tennessee, Georgia, South Carolina, Texas, Oklahoma, Florida, you name it. Inventory across the South in America is skyrocketing.
So stop right there, guys. Those are the states that a lot of home buyers were flocking to, from California, Washington State, Oregon, New Jersey, New York, Maine, Delaware, those northern areas, right? Whether it be on the East or West Coast. Those are the states that they were flocking to. And the two biggest ones that were actually three in there are Florida, Texas, and Tennessee, guys. Let's look at this real fast, guys. Let's dive into this real quickly.
Year-over-year growth across the South registering crazy levels, everyone. We're talking 59% in Florida, Georgia, 48% North Carolina, 31% in Texas. And even if we head on over to Arizona and California, we're now seeing big inventory growth of 40% year over year.
And these are listings, not sales, guys. Listings of homes that have been listed for sale and that they have not sold yet.
And later in this video, I'm going to reveal to you the 10 cities where I think prices are going to drop the most due to this spike in inventory using data from Reventure app. But first, I want to show you all the reality.
So what now, guys? Let's go ahead and stop right there. Now, guys. So what we're hearing right now from Realtor.com is this here. Is there's a 40% spike in listing inventory, meaning that it has not sold yet. It has not sold yet. Okay, these are not sold properties; these are listed properties. Very interesting to see. So the natural question to this, guys, is, okay, why is no one buying? Why is no one buying? Again, we got these are logical questions that we have to answer now. Okay, let's go back to our guy real quickly on this. He's going to talk about this real quickly. We're going to dive into why are buyers not buying in this market. That's a logical question. Let's dive into it. Here we go.
Redfin just released new data on the U.S. housing market that's showing some very concerning trends as we enter the latter part of 2024. Namely, the home buyer demand continues to go down with the level of price cuts now rising to the highest level in nearly a decade. Redfin's recent housing market analysis showing that pending home sales are down 7.8% annually, the biggest decline in nearly a year. You can see that this pending sales index is now down so low that it's about 40% less than the peak of buyer demand in 2021. And the more that home buyer demand declines, the more likely it is that prices are going to drop, because more sellers on the U.S. housing market are now waking up and realizing that lower interest rates and mortgage rates isn't bringing the buyers back in. So the only way to get any traction on your listing is to price it appropriately. With the same.
So in other words, he's talking about cutting price points, and I'm seeing it all over the Dallas-Fort Worth Metroplex. $10,000, $20,000, $50,000, $100,000 in price cuts, depending on what area that you're in. Because as we saw in the previous video, There's a 40% spike nationwide, guys, nationwide, right? Of listings spike. And the question is, okay, with those spikings, what's happening is when your property is sitting on the market for a long period of time, you have to again begin to look at what's the proper price point when it comes to listing my home for sale. So therefore, you get those rate cuts. Let's get into it. We almost done.
Same data from Redfin showing that 6.6% of listings had a price drop through the first week of September. This annualizes to over 25% of listings in a month, with the price drops on some listings now getting so severe that the values are falling back to their mid-2021 levels. But it's not
Wow.
all good news for you guys as home buyers out there, because even though the prices are starting to go down in many cities and states across America, they are still way higher than their long-term norms, and they still feel very expensive for most home buyers, because what
Mm,
happened during the pandemic is that the prices went up at a much faster rate than the income levels and the rent levels, which has
right.
caused a tremendous disconnect
Mhm,
in valuations. It's leaving many regular home buyers
mhm,
and investors to
mhm.
continue to wait on the sidelines.
Correct.
Now, according to Redfin and some of their real estate agents,
What that means, guys, is money on the sidelines. Whenever you have an inflationary, happy economy with also higher taxes, because remember, inflation is a stealth tax, right? Whenever you have higher taxes due to higher inflation, guys, the market that there's no organic cash flow or currency of exchange, right? And what happens is when that actually happens, money sits on the sideline to wait for a better environment. Does that make sense? Let's keep going.
they're saying that buyers are holding off on closing until the end of the month in hopes that rates will come down by more. They're also seeing people postponing until after the presidential election. Buyers tend to be more
Oh,
careful about major
yeah,
financial decisions around a consequential
yeah,
election.
yeah.
And I think it's really interesting when I talk to a lot of realtors out there, I hear a lot of people talking about the election
Yeah,
as a reason that buyers aren't coming back and that demand is still down.
correct.
And the idea behind this is that somehow home buyers who've been thirsty to buy a house for the last 3 or 4 years and are
Okay.
desperate to buy are simply not buying due to the election, whether it's Kamala Harris or
Mhm.
Donald Trump who becomes president. And I find this argument very amusing because I don't buy it. I don't think a home buyer who's been desperate to buy is going to put off buying if they find the right house at the right price point
I agree.
because of an
Agree.
election. I think rather this is a narrative and a talking point in the real estate industry
Yeah,
that people are using to try to justify why
yeah,
the buyer demand is still so low.
correct,
And I think the longer that this goes on for
right,
with really low buyer demand and no bounce
right.
back, the more people will wake up to the reality that it's the prices that are too high.
Correct.
It's sky high prices that are
Every
keeping
time,
buyers on the sidelines.
every
It's
time.
not mortgage rates. It's not the election. It's
Correct.
not the NAR settlement
Come
agreement.
on.
It's the fact that no one wants to pay $600,000 for a house that was worth $300,000 4 years ago. People don't want to do it, and they actually just don't have the money to do it. I'm going to show
Thank
you
you.
two graphs
Thank
here,
you.
everyone, that
Look
are
at this.
very important for you to
Listen to this.
understand. The first graph is the personal savings rate. You might have heard me refer to this data point several times in the last month or
Yes.
two. And the big problem right now in the economy is that the personal savings rate in America is down to 2.9%,
Yes.
meaning that the average American only saves 2.9% of their income. Now,
Yeah.
that's the second lowest personal savings rate on record.
Yeah.
The only other time Americans were saving so little money due
Mm,
to the cost of things being higher than the incomes was
yes.
the mid 2000s at the peak of that last housing bubble.
Remember, guys, I told you, people were what I was hearing people actually say a lot of the times is they were saying that, hey, LaDale, once the rates go down, what's going to happen is people are going to run to go out and buy properties because the rates are going down. I said that'll be accurate if there was not two additional variables. Number one, you have inflation outpacing wages, right? And number two, you actually have also people's savings are at an all-time low and their credit card debt is at an all-time high. Those are bad, bad, bad variables, right? Because if someone cannot afford, if someone has a record low when it comes to savings, right, and they can't afford said payment, they can't bring a down payment and or even pay their monthly payment because again, inflation is outpacing their wages. They can't afford a monthly payment. Number two, they have no money in the bank. And the DTI, because of their credit card debt, is at an all-time high. This ain't hard to understand. Does that make sense, guys? Now, let's go ahead and move on to the next thing, guys. We're going to move on to the next thing now. Now, the next logical question, guys, is this here. All right, is now if someone cannot buy a house, what's the next pivot, guys? Simple. The next pivot is going to be renting. Renters can't buy a house as well also. So let's go back to my guy real quick fast. He's going to talk a little bit more about renting. Here we go, guys. Again, these are logical questions. You can either be emotional about it, or you can be common sense about it and begin to understand where you're at, right? And then pivot. Here we go.
You can see in the mid-2000s, the savings rate dropped to around 2.4%, 2%, and was around the same level in late 2007 that it is today, before we had the big crash. And then the savings obviously went up during the crash because people significantly cut back their spending. And so this is the first thing to understand. Americans don't have excess money. There's no discretionary income available to buy houses at crazy prices.
Correct.
That's what the record low savings rates are telling you. And it's kind of confirming that we're in a bubble.
Yes, we are.
Right? It's confirming that the housing market's in a bubble, that the economy and consumer spending is running on fumes.
It is.
Because there's just nothing left over for Americans to put in their bank account and, afford a down payment, for instance.
Correct.
Now, the other issue is that the payments are also way too high relative to people's incomes. The typical mortgage payment as a percentage of Americans' income over the last 40 years back to 1984. And what you can see in today's market is that the typical home buyer needs to spend 40.5% of their gross income on their mortgage payment. Typical mortgage payment of $2,700 a month, which annualizes to around $32,000 a year on median income of $80,000. And so this is an even higher payment ratio than we saw in 2006 at the peak of the last bubble, in the early 1980s when mortgage rates were like 15%. So we've really never before seen this lack of affordability on mortgage payments. And really what I think is going to need to happen, we're going to need to get to this dotted line, which is 30% mortgage payment to income ratio. I think if we get to the 30% mortgage payment to income ratio, which is the long-term median, we'll see buyer demand return. However, you could see we're a long way from that occurring. And I've been talking to actually a lot of mortgage brokers down here in Florida. A lot of them are saying that the mortgage applications that they are seeing are at crazy high debt to income levels.
I told you.
They're saying they're seeing people apply for FHA mortgages at
I told you guys this here. I told you that the one variable that people are not paying attention to is that DTI, the debt to income ratio. This is the reason why renters can't buy a home right now, is because of the fact that the DTI is too high. People owe too much debt compared to their income. Inflation is outpacing their wages. This is not hard to understand. If you're not emotional about the situation, you can be emotional about it, but do not discount the common sense. If I didn't get wise counsel, guys, So again, the reason why renters cannot buy homes is because of the debt to income ratio is too high. It's not hard, guys. I know this may be one of them boring standpoints. I don't care. We're gonna talk about it. Talk about that thing now. Here's another thing, guys. Let's dive into this real fast. Now, here's another issue that's been going on as well. Also, guys, I want y'all to see what's going on. Is homeowner crisis. Here's another issue that people have been talking about. It's insurance costs. They have risen. They have risen up to 21%. These are insurance costs. So we're going to go to insurance professionals, right, who specialize in this to talk more about this. Okay? Patrick David and the Valuetainment team did a good job of explaining this, guys. So we're going to let them come in real fast and explain this, guys. Listen very clearly. This is another cost that a lot of consumers are not understanding or even factoring in to their home buying situation. Let's go.
U.S. home insurers suffer worst loss in century. Okay, let's go through this one here. Yep. So U.S. home insurers suffered $15.2 billion of net underwriting loss last year, the worst since at least 2000, and more than double the previous year's losses, driven by natural disasters, inflation, and population growth in at-risk areas. Keyword, population growth in at-risk areas. What is population growth? Where did it go to? Florida. What's at risk? Florida is one of them, right? Hurricanes.
Yes.
Robert Gordon highlighted that escalating coverage demands and skyrocketing insured losses are due to more homes in high-risk areas and rising construction costs.
Yeah.
He noted that the increasing frequency and severity of weather-driven losses as a major uncertainty affecting the market, regulatory constraints in states like California, delay pricing approvals, the fires in California, exasperating market deterioration. Gordon urged stakeholders to work together for sustainability. By the way, that's a key word. Stakeholders, meaning the Department of Insurance and the insurance carriers, you guys, and the state, you guys got to, because this is not like insurance, you're bad people, you're so expensive. They're not making money, and they're leaving state. So they're saying, listen, you don't want us? We're out.
So listen to what Patrick said. Insurance companies are saying that they're not making any money because the cost to rebuild a home and also replace cars have gone significantly up. Up, guys. Jeez.
Totally fine with this. It's not like we're negotiating because we're trying to get the better deal. To work together for sustainability, while Minnect pointed out regulators struggle to balance attracting insurance and maintaining affordability for consumers. So this is a problem for both sides. States fear insurers leaving. Yeah. Insurers fear that states going to demonize them so much there's no profit margin for them to even stay in the states. That's what's going on. Tom, your thoughts?
So one of the things here, California delaying pricing approvals. When Pat just talks about the Department of Insurance and the insurance regulators that are at the state level, in California, they set what's called the span. It's a pricing span that they allowed to raise rates or here or there, because what they're trying to do is ensure that there's affordable insurance in California, and that maybe pick a company, insurance company A is doing business in Galveston, Texas, and there's a lot of risk down there because it's on the coast where the hurricanes come. And then they're also doing business in, California, in an area not affected by wildfires. Right. They don't want the insurance guys to raise the price in California to help subsidize Houston and go back and forth, because the insurance people are running a nationwide business. So you also have the state regulators delaying approvals, and you've got the person that gets stuck in the middle and screwed is the consumer. The consumer's trying to get coverage for their home because they have to get coverage for their home because they have a mortgage on it. And Wells Fargo says, hey, you have to maintain loss coverage on your house and give me the policy number so that I know that you've got coverage. So if there's earthquake or fire or whatever, it's going to pay to rebuild it. Well, then the insurance people are going, well, I got to raise the rate on here so I can make a buck. And the other part of it, here's what's chasing the insurance carrier. Cost of labor and drywall and common construction materials are up 30% in 3 years. So what does that do to the cost to the insurer if your house burns down?
Come on.
It costs them more to rebuild it than they had estimated when they told you it was $300 for your insurance. So they lost money on the policy and didn't have the money to do it.
This is the reason why, guys, I always say that when it comes to cost of goods, or when it comes to inflation pertaining to cost of goods, companies do not eat costs. They pass the cost on to the consumer because companies want a profit margin. You have gross profit minus expenses gives you a net profit. They're after the net profit. They're not going to eat a higher cost to make you happy. They're going to pass that cost on to you. It's economics 101. That is the reason why investment dollars are more attractive to a lower regulation, lower tax environment. It's common sense, not based on what I say. The insurance companies are saying the exact same thing, guys. My God, let's keep going. Keep cooking.
We're all in insurance here, and I think there's a lot of perspectives here at the table, but the one that really gets nailed is the consumer, because in California, they'll delay the pricing approval, and then suddenly you have a 20% year-over-year pop, which happened in car insurance, specifically in California.
Go to the number. By the way, do you know last year, out of all the costs that increased the most, everything,
Yeah.
payment, food,
Yes.
clothing,
Yes.
auto insurance,
Yes.
home insurance. Out of
Yes.
all of them, you know what increased the most last year price
Up
point
to-
wise? Did you see the number? Car insurance up 21%. Rob, can you pull this up? Just type in car, auto insurance 21%.
Just moving here,
And
Pat, it doubled for me. coming
Damn
here.
straight. And that's
Almost
single year, Pat. Pat's talking
Wow.
about single year, not multi-year. When we talk about 30% inflation in the grocery
Right there.
store,
Look at that.
that's 3 years.
February 2024, the average cost of car insurance in U.S. has increased 21%
Jeez.
year over year, according to the U.S. Bureau of Labor Statistics. And by the way, when they broke it down, so let's just say, Vinny, you're running $1 billion a year business, okay? And you look like a CEO, so you're running $1 billion a year business the way you're dressed,
Business,
okay?
business.
And all of a sudden, you notice that, you know, the amount of cars being stolen has skyrocketed, where you're having to pay insurance out of your money that you have in your account. It's being depleted more and more and more and more and more.
Yeah.
And you notice, man, the cost for this is ridiculous. So you increase 5%, you're breaking even.
Yes.
You increase 10% to make 5% profits, you're still breaking even.
Correct.
You increase 15%, you're still losing 6%.
Correct.
You increase 21%, everybody says, why did you increase it 21%? And they say, guys, we're not making money. So then what's the next move you're going to do as a CEO?
I gotta stop right there, guys. I gotta play something for the people in the back row. Here we go.
Brother, what's that? What's that, brother?
Come on, y'all. 21% up for car insurance. Come on, let's keep going.
You're going to go to your guys and you're going to say, show me the best margins by state. That's exactly what you're going to do. What state do we make the biggest profit margin on? And you're going to have an Excel spreadsheet that breaks down all the states.
And we're moving.
And no, you're actually not moving. You're actually doing the following. So it's going to say, let's just say Oklahoma. I'm making up numbers. Your profit margin there is 29%.
Yes.
Kansas, 27%. South Dakota, 22%.
Preach.
And you'll rank the top 15. You'll notice at the bottom, it'll say California, minus 28%.
Good God.
Texas, minus 27%. New York, minus 26%. You have to sit there and say, guys, we're doing one of two things. Either you increase the rates and be a niche competitor,
correct,
where you're purely in the niche insurance business. You're not trying to be to everybody, and you stay in that state. Where you decide, like in insurance, there's companies that you can go and look at term insurance companies. Some companies sell term insurance so cheap, but on the back end, they're not doing anything. But it's so cheap for healthy non-smokers, and that's it. Super expensive for anybody about 45. You get to decide who you're going to make that insurance cheap for and expensive for. And you'll say, guys, the only thing I'm interested in giving term insurance policy for, if you're under 40, non-smoker, you're not heavy, I'm going to give it to you cheaper than anybody else in the market. What if I'm over 40, heavy, and I'm a smoker? We're going to be the most expensive in the market. That's all these guys are going to do. Florida, California, some of these states with high risk, or some of these cars that are being stolen in Chicago, Illinois, you're simply going to say, we're not trying to win that market. Increase the price, let them leave us to somebody else. You have to make that choice, but it's purely economical. FYI.
So again, guys, man, it is, man, this is such a great breakdown by Patrick and the squad, man. Again, they're killing the game again, guys, man. It's economics 101, man. And it's a company very rarely eats costs unless they have to. What they do, they pass it on to consumer. This is, man, wow. This is, and guys, we're not done. We are not done at all, guys. Again, I know this is one of those bad news type of scenario. It's not all bad news. I'm gonna get to the good news as well, but we need to know where we're at so we can prescribe the right counter move, guys. All right, we gotta do that. All right, guys. So give me 1 second. We'll be right back. You are concerned about what's going on with this economy. I know I would be, man. You have the stock market not doing too well. You have inflation outpacing wages right now. And you have major companies looking at laying off a lot of people. Man, I had a friend of mine whose wife works for a major pharmaceutical company, and they're talking about laying off Scientists, man, scientists. It's getting real out there, guys. But hold on, wait a minute. It's not the end of the world for those that actually have a counter move. More than ever, it's time for everyday Americans to begin looking at a side hustle, a business for them to begin building now, and for them to be able to have the ability to pass the business on to second and third generation. Now, what business model is best for you? That's a great question, and the only person that can answer that question is you. The good news is a good friend of mine, Matt Sapala, actually did a good presentation on presenting the passive income blueprint. 3 effective ways to generate $1.5 million in passive income. The most powerful word in business is cash flow. And even a more powerful word is passive cash flow. I know, because I've been able to live the life of my dreams because of passive income. Most individuals focus on commission-based, generating commission. What if you can actually generate $1.5 million in passive income that can change not only your life, but generations to come, guys? Click on the link below or swipe up, guys, and I think you'll be blessed with what you see. God bless you. See you on this side. All right, guys, we're back, guys. We're gonna walk in, and we're gonna go back to this type of thing. Did the Fed cut actually help the market? Now we're gonna dive into this as well. There's another topic, and my man, Anton Daniels, man, I love this guy's content, man. It's phenomenal. And let me bring it up. There he is. And he answers a phenomenal question concerning this. Anton killed this, man. All right. He answered the question. He said this here. He said, why middle class wages aren't growing? Because remember, I say, and by the numbers, inflation is outpacing wages. It is, but don't take my word for it. Let's talk to CNBC. So my man Anton killed it. Shout out to my man Anton, man. I got to give my flowers to my man. Here we go. Let's dive into this real fast.
Middle class wages are not growing. Let's spend 10 minutes here, ladies and gentlemen. Make sure y'all hit a like for the algorithm, subscribe to the channel, and turn on your notifications. Get your tickets. Discount code in the description. Get your tickets. Discount code Anton, and then make sure y'all tap into the Patreon. Let's get it, y'all.
Between 1979 to 2024, productivity in the US soared by 80.9%, while hourly pay grew by just 29.4% during the same period.
The paychecks of typical workers have not grown nearly as fast as overall economic growth over the past 40 years.
In June 2024, 2/3 of middle-income households believed that their income was falling behind the cost of living.
I think that many Americans feel the financial struggle because their household budget and their household balance sheets are facing so much pressure.
Jesus.
Every time I check my local mom group on Facebook, I see requests or people asking where they can get some financial assistance to pay utilities or assistance with rent. And it's concerning because these people...
Guys, again, this is not spin. These are actual facts, data, numbers. Okay? People are telling you, wait a minute, I'm hearing one thing in the news, but I'm feeling and seeing something totally different, right? In the real world. Again, this ain't no spin over here. This is facts.
People are working full-time jobs and they just can't make things work right now.
The issue of...
Go back to your baby daddy.
Wage trends, wage suppression, I mean, it just could not be more central to what has happened to the middle class over the past couple of decades.
So what exactly is keeping the middle class from earning a higher paycheck?
So you guys, you actually saw the title to this. It was why the middle class wages aren't growing. Hello. Aren't growing.
I think people think inflation is a policy problem, but wages are my problem. And it turns out wages are not just your problem. Wages are entirely a policy and political variable.
The main goal of policymakers at the Federal Reserve is to ensure maximum employment while keeping prices stable. They rely on various economic data to guide their decisions, including the natural rate of unemployment.
Economists produce this thing they call the natural rate of unemployment. It's like the lowest unemployment can go without generating inflation.
Throughout history, the natural rate of unemployment has hovered between 4.5% and 5.5%.
And then we look at actual unemployment and how often it is above that estimate of the natural rate versus below. And if you look at the years since 1979, we have spent far more time with actual unemployment well above that estimate of the natural rate.
Between 1949 and 1979, the actual unemployment rate was cumulatively 15.3% below the natural rate of unemployment. In contrast, the unemployment rate was cumulatively 35.7% above the natural rate of unemployment between 1979 and 2017.
Wow.
I wonder how much of that was intentional. You know what I'm saying? It's almost like a lot of these market corrections, a lot of these assumed market corrections almost seem like it's 100% manufactured. And so I just be in a position to where I can take advantage of these market corrections. And when I say market, I'm not just talking about the stock market. I'm talking about
Listen to what Anton is saying, which I totally agree with. He's saying being in the proper position to take advantage of these market corrections, whether they are manufactured or not. Are you properly positioned? Don't you worry. Your partner got you in a second. We're going to help you out today.
corrections and everything, real estate, stocks, all things that we then see is directly an impact or a result of whatever administration was in office at the time. So when I see all of these jobs or the layoffs or the fact that America is just basically a banking country now and that they're too big to fail, the banks themselves. And why we had to bail the banks off because we don't actually make anything. But part of that goes back to the fact that the Clinton administration opened up our borders to be able to have manufacturing offshore, to say that we were going to lower prices and ultimately become competitive, when in reality, they just jacked up prices and it didn't help anything. When I see certain things happen, almost all of it seems like it's manufactured or it's a direct result of the policy decisions that we don't really know how it's going to impact us until years after these Congress people and these legislators are out of office in the first place.
And again, guys, to be honest with you, he's actually right about that. Notice how Congress, when we were talking about the Senate and the House, how when it came to Obamacare, they exempt themselves from it. I wonder why. They have a better type of coverage. When it comes to them investing in stocks, they say they're not part of inside trading, but it's just strange to see how someone that makes they're making six figures can be worth 22, 23, 40, 50, 60, 70, 80 million dollars. What did you sell? What did you produce? What business did you start? Or did you just invest in the stocks of companies to where you knew the money was going to flow to? Don't know. Let's keep listening.
This has real-world consequences for the American middle class because wages tend to grow faster during periods when unemployment is low. The Economic Policy Institute estimates that just a 1 percentage point drop in unemployment leads to wage growth of 0.4 to 0.9 percentage points for workers near the median of the wage distribution.
The best bargaining chip any employee has to getting wage growth is going to the boss and saying, I'm going to go somewhere else unless I make more money.
That's a fact.
And that's just not a credible threat when unemployment is high. The only people whose wages are not very affected by unemployment are...
Well, it's not a credible threat. It's not a credible threat.
Not a threat, no.
When you're not a valued employee. So just because you say, hey, I think I'm about to go to somewhere else, then it no longer becomes a credible threat.
If you ain't valuable, they'd be like, peace.
When you say, yo, I'm about to go somewhere else, it no longer becomes a credible threat if they can afford to have you gone and they don't value you as an employee. And just because you work.
So again, Anton, shout out to you, brother, man. Keep doing what you're doing, brother. Keep put out that good content, big dog, man. Love this, guys. He goes a little bit more deeper, right? But we're gonna pause it right there. But man, it's even as an employee, you have to learn the art of negotiation, because you're negotiating when it comes to them hiring you, and you're also negotiating when it comes to an uptick in your salary and or benefits, right? So that, yes, that's an art of negotiation that has to happen, whether you're an entrepreneur or you're an employee, right? Every single time. If you are banking that an employer has your best interest at heart, you will be let down very quickly, guys. Very quickly, right? There's no one that values you more than you. So has the Fed cut actually worked? Not necessarily, as far as not forgive me, not say worked. Forgive me. I got to make sure that I'm factual. Has it helped? It depends on how you positioned. It depends on how you are positioned. Here are my thoughts, guys. Here are my thoughts. Remember, I made the point concerning Congress, how Congress, Senate and House members, are making six figures, and then in a short amount of time, they're worth millions upon millions of dollars. That's only because of their stock portfolio. We all know that. But at the exact same time, here is something that they've done that you may not be doing, is they are properly positioned, whether it is legal or illegal or not. They are properly positioned to take advantage of their position. Let me say it again. Congress, Senate, and House members are properly positioned to take advantage of their current position. Have you done the same for your personal e-commerce, your personal economy? If the answer is no, I'm not surprised you're struggling, you're broke, and you shouldn't be surprised as well. It is real simple. I get tired of going on these lives, and all I hear people talking about is they're complaining about the government. Keep complaining about the government, but what the hell are you doing? What's your counter move? They are fleecing you. So what are you doing to position yourself to begin to take advantage of the situation yourself? Stop complaining about the tax code, right? And then you know how to take advantage of the tax code because it's called a code. Those that know the code know how to properly counter move to decrease their tax liability. It's not that damn hard. It is not at all. Put it like this. Those that have 401ks and IRAs, guys, you're invested in the exact same stocks that or not the exact same, but mostly the same stocks as Senate members and Congress members are. Most likely you are. Here's the difference, right? Here's the difference. They have access to information that you may not have. So that's kind of an advantage on them, right? Cool. What's your counter move? Because what's happening is if your portfolio is not increasing at close to near the value that theirs are, you're losing. You're losing. How is it that Nancy Pelosi, respect to her and her counter move, guys, is outperforming Warren Buffett in the market? That makes no sense at all. None, unless she's properly positioned. Now, don't get it twisted. Buffett is positioned right as well. He sure is. There's a reason why he's one of the wealthiest men in the world. Don't get it twisted. But the Senate, Congressmember Buffett, Bezos, Elon Musk, myself, anybody else, Brian Abelson, Deontay Blade Ford, Brandon Anthony Clark, I'm naming people that you might not even know. Myron Golden. Let me see, who else can I name? TD Jakes, Keon Henderson. I'm naming some brothers you may not even know at all, period. Presley Swaggerty. These are moguls in their respective industries. They're properly positioned, most likely better than you, because it's something that they know that you do not know. So I got some advice for you as far as the counter move, guys. Right? Because you're here for not to be lectured, for assistance potentially. And I thank you for allowing me to be able to speak into you, right? I hope I'm giving you some value. My question to you is, what do you spend the most time doing? On Instagram, going to the club, partying, or reading a book? Because your enemy knows how to hide things from you, is to put it into a book, no matter your color. So what are you doing? The difference between Buffett and you, LaDale and you, Deontay and you, Presley and you, Myron Golden and you is one thing. What's between your ears? They know something that you do not know. That's why the Bible says, people perish because of lack of what? Knowledge. What don't you know? We're in the information age, guys. We're in the information age. You get information that fast. You're in the information age, guys. You can literally go through university online. So let's stop bitching and moaning, guys. Only let's learn how to come. Now, here's what I'm gonna tell you, guys. I'm gonna go here real fast. One sec here. One second. Here's what I'm saying here. This right here, joint venture investing, guys, in real estate, any business model, is the strongest investment strategy that I've ever seen, because it allows for you to plug in your weaknesses in your investment strategy and your team. Right? Let me give an example, guys. Last week, I did a presentation on this. I'm just going to go to the first two or three pages. Joint venture investing. Here we go, guys. We're going to talk about what is joint venture investing and some examples, and we're going to determine if you're an active or passive investor. But I want to focus on the first two. And really, these three right here. Here we go, guys, so you can see everything. These three right here: equity joint investing, contractual joint venture, right? Not really consortium, but cooperative joint venture investing, right? These three right here, and also strategic alliances as well. These four right here, guys, you learn what these are, guys? Unstoppable. Because what you're weak in, your partners make you strong in. It's real simple. I'm not gonna go through them again. If you want to read it again, guys, understand what these are. Go to last week kind of Real Estate Friday Live. Listen to that one, and then you'll be able to see it. We're going to see how hungry you are. It's free. Don't cost you a dime. It's free. Learn it. It's real simple, guys. So it's simple. Joint venture investing is, in my opinion, the most powerful investment strategy on the planet. Let me prove it to you. Do you know when it comes to your 401k, IRA, Roth IRA, 403b, your retirement accounts, that's a form of joint venture investing. You participate in it every single day. You just don't know it. Magic Johnson formed a JV with Starbucks, killing the game when it comes to Starbucks. Killing the game. I've made, by God's grace, millions of dollars because of good, properly structured joint venture partnerships. It's not hard. It's very simple, guys. Very simple, guys. It's extremely simple. I hope this helped you out, guys. I hope this helped you out. I hope it did. Most individuals that I talked to today, they're really concerned about the economy, specifically the volatility of it. Number one, they're really concerned about inflation. Now, the area of their concerns really centers around the variable of inflation. Inflation right now is really outpacing people's wages, number one. And number two, it's beginning to affect their 401k and IRAs because their retirement accounts are connected or intertwined with the stock market. Over the years, I've been fairly successful in real estate investing. Currently, I own about $35 million worth of real estate under management. And also my partner and I have been able to build our private equity and venture capital firm to about $1.2 billion worth of assets under management. Now, this success has taken place in up or down economies. Now, whenever there's volatility in the market, opportunities begin to show up. There are three investment strategies that, if implemented the correct way, any investor can go from 0 to 6 figures in the next 6 to 12 months. Click on the link below or swipe up and let's talk through these strategies. All right, guys, here we go, guys. Man, I got something for y'all today, baby. All right. I'm always asked, LaDale, can you teach me how to invest in real estate? The answer is always yes. Okay. But I want you to do this real quickly. If you're on Instagram, if you're on YouTube or Rumble or even Facebook or any other platform, guys, I'm giving away a free ebook. It's completely free. FREE. I want any of your money, guys. It's distressed property investing, right? It's distressed property investing. It's real simple, guys. All you got to do is go to the link below, click on it, and go download the free ebook. It's literally notes from a masterclass that Cliff and I did on distressed property investing. We went through the bag on this one, guys. If you do not want to scroll below, right, you can always scan on this QR code right here, right? And you go to that same place, right, and download the free ebook. It's completely free. Also, guys, real quickly here, if you're on TikTok, Instagram, or any other platform that you're not able to go below and click on the link or scan the QR code, don't you worry. DM me the word, guys, real estate. DM me the word real estate, and my team will get you out that link today. It's the same link where you can get you can scan on the QR code or click on the link below. It's the same link, guys. Again, don't want any money from you at all, guys. We want to get you access to the information, right? Because as a man thinketh in his mind, so is he. Also, guys, I'm always saying, LaDale, I'm not interested in real estate investing, but I do want to become an entrepreneur of some sort and begin a side hustle. Great observation. Hey, is there anything else I can look at? No problem. A good friend of mine, Matt Sapala, did a video on the passive income blueprint, and he did a case study on your partner, man. And where he walks through the top 3 investment strategies to generate a significant amount of cash flow on a passive basis, guys. You're going to be very surprised at one of the business models that he talks about and how he's made his millions in, guys. Again, it's free. Didn't cost you a dime, guys. Go to the link below and click on the link below, or you're welcome to scan on this QR code. It's real simple. But if you don't want to do that at all, no problem with it at all. DM me the word passive income. My team will get you out that same link. Don't you worry, your partner got you. And lastly, guys, man, you see me looking better than you every single time, guys. People ask me, LaDale, can I get some of your swag, baby? I always say yes, but you can't look better than me because I look better than everybody on the screen. Don't shout me down, talk Jesus about that thing. But anyways, guys, hey, guys, you're welcome to go below, guys, and get your merch, baby. We call it the bag, baby. Here's our saying. Whenever you begin making money in real estate or any business model, we always say, show us your diploma. Really, your diploma is your paycheck, but also your merch, the bag, guys. Scan on the QR code below, or also, guys, you're welcome to also scan on this QR code or click on the link below, guys. We're excited about our merch, baby. It's called the bag, baby, from I Got That Bag University. Don't shout me down, baby, because I look better than you. Take the damn picture for your mama there. But anyways, guys, thank you so much for your time. God bless you. I pray that we actually gave you some good knowledge today, guys. That everything was well. Again, give me your thoughts. Let me know below, guys, what you guys think about it, guys. Let me know if it makes some sense, man, if you don't mind, guys. Oh, yes, guys, one last thing. People are always asking me, LaDale, do you do any other podcast? The answer is yes, guys. We have something called the Counter Move Podcast, guys. Here's a little brief preview of what it is.
Party, I'm in here grinding, money I'm stacking, why they rock diamonds? I can't relate to them, ain't my chick calming. I set a goal for me 2 or 3 commas, 7 figures, 8 figures to 9 figures, on a slow pace to get rich quick. Same time we just think different, cause when you make it, it hit different.
Yes, so that's the Counter Move Podcast, which comes on every single Thursday at 8:30 p.m. We take a situation within society, unpack it together, sit down and reason together and prescribe the right solution. And also, guys, man, we've began a interview series on the Counter Move Podcast, guys, and I'm interviewing politicians, moguls, and industry guys. Here's a little brief preview of that one as well. Steve is LaDale. How do I get into those rooms? Well, this interview series is just for you. So welcome to the room.
We on now. They respect us cause we on now. Money up, run the whole town. Don't
Guys, that is the Kind of Move podcast, the interview series, guys, man. It happens, I believe, once a month. We interview a mogul. The last one we did was a former NFL star that's turned a financial services mogul. His name is Chauncey, guys. Go to my YouTube page or Rumble page or any page and look at the interview. You'll be pleasantly surprised at what he talks about the NFL, guys. But guys, thank you so much for your time. God bless you. I hope I gave you some value there. You know I end it every single time, baby. Before you leave, while you can, baby. You see that thing, baby. Take that damn picture and give it to your mom and them. And say it with your chest, guys, and holler at your partner. God bless you guys. See you next week, guys. All right. Don't get mad at me because I look better than you. All right, y'all. Peace.
Bless God, give thanks. Bless God, give thanks. Bless God, give thanks. Big God, big grace.